Hey, welcome to Jazz After Dark, everybody. How you doing out there? Been a while, huh? Hey, tonight will be just a bullet bourbon kind of a night, just a little glass there to enjoy. It's actually a lot. But we're going to talk about something a little different tonight. I would like to focus on a different way of looking at the investments that you choose to try to outperform. Not saying you're gonna, but this is kind of the behind the scenes look at what mutual funds do, and more particularly like active funds do. Not a lot of them are great these days because they're getting really into that theme world where it's like Chase AI or Kathy Woods. I don't know what she's doing. And so it's tough to say that this is what they all do. But if you manage money on an institutional level, then you either need to perform according to what the goals of the fund are, or better, or you lose your job. And that's just how it works. Now, you guys, as individual investors, maybe, right? You're just out there doing your thing. You always want some advantage. And often what I find is people think the advantage is finding a stock that will do well and trying to buy it at the right price and sell it at the right price. Of course, we all want to do that. I'm not saying that's not a part of it. But from my background, I learned so much. I used to be the guy behind the scenes. I wasn't in front of the clients. I didn't do that. I managed the money and had some great inspirations over my short career there. And then started managing money. I'm like, I could just do this myself. So I started Jazz. But instead of thinking, okay, I want to have a group of 20 stocks that outperform the market and I'm going to just keep trying to find them. There's other things you can do too, and it has nothing to do with the upside. And so tonight I want to kind of go through that. It's going to be a little geeky, but that's what these classes are for here. Just dive into it and see what happens. Now, when you build a portfolio, of course, you have a goal. If you want to move at 100% the speed of the market, you build that portfolio. If you're more risk averse and you want to move like half the speed of the market, you can do that as well. So we have generally a handful of different portfolios here that move in that pace, 100% plus, and then we go 80%, 60%, and then it's really like 30% for the retirees or the short-term money. So when we build a portfolio, the upside is everything. We're very happy with that, right? But the downside is where you actually make your future returns. So that's like the 1 minute takeaway from this is that in portfolio management, if you're going to build something, the downside is where you make your future returns. If you're not falling as much, but you're going up as much or more or whatever, then those are the future returns. You get what I'm saying? Stock market falls 20%, you fall 13%. And if you're participating 1-for-1 on the upside, but you're not participating 1-for-1 on the downside, you could see how just a few pullbacks and all of a sudden you look like a hero. Your performance looks great. A lot of our clients point that out. They're like, you're beating the market. And it's like, sure, if you want to look at it that way, but in reality, all we're doing is just avoiding some downside. So how do we do that? What are some of the things we can do to build a portfolio that participates on the way up as much as possible, if not all of it, but then doesn't fall as much? Let me give you one example here tonight. So you know that everything has been studied on the planet, right? Like anything you can imagine. Different correlations, different oscillators, indicators, fundamental analysis. We'll cover that here. But everybody's paired everything together and tried to, kind of found their strategy. Well, one widely known way to do this is by using buckets of free cash flow stocks. So I'm just going to talk about it, right? So if this is too much, hang with me. I'll try to define as we go. So what you would do is in good times, this is less important. But if you believe that there's a weakness on the horizon or just want to protect a little bit, you can swap out your stocks with stocks that have higher free cash flow, right? And then you can compare them 1-to-1 and see what you like. But if you have a portfolio that has the majority of stocks as a high free cash flow type companies that are inside of them, you'll do better on the downside. You won't fall as much, right? And I'll explain in a second, but if you have a portfolio of biotech stocks, semiconductor stocks, right? They're all the rage right now. Well, when the market falls, you're going to fall more than the stocks that have higher free cash flow. You know what I'm saying? I'm gonna show you an example in a second. I don't even know if this is ready, but we're gonna do it anyways. The reason this is, and if you want to look it up or scan by stocks or whatever, you're looking for free cash flow yield. And don't let that confuse you. Free cash flow yield is just how much will they add to their free cash flow given the earnings that they have compared to the price of the stock. So if you have for whatever reason, I'll just use a random number. If you have a stock that has a free cash flow yield of 5%, then for every dollar of earnings that they bring in, 5 cents of it can actually add to their free cash flow compared to, at least where the stock price is at for now. It does fluctuate, right? Stock prices fluctuate. You get what I'm saying? So that's how we kind of look for it. We're looking at free cash flow yield. And the reason for that is for every dollar of earnings, they have money going to free cash flow. This is the exact same as saying for every dollar that you go out and work for, you're able to put 5 cents away in an emergency savings account. It's the same, right? You have no use for it at the moment. All your bills are met, everything's good, 5 cents. It doesn't sound like a lot of money, but that's just for every dollar that you earn. If you earn $10, $100, thousands of dollars, whatever, you could see how that adds up. And so a low free cash flow yield needs to be defined. At what point is it low? At what point is it high? So first of all, let me show you this here. This should be nowhere near where it needs to be. I apologize. Let's just bring that in here. So I talked about this on a closing beat a little bit, but not as detailed. What we did is we actually took this is for the last 20 years of data here. And so what we did is each month we took the S&P and divided them into 2 groups, those that had low and those that had high free cash flow. Then we essentially broke them into pieces so we could see outliers and things like that. We've got the average on there, but we took it a step further. We followed those returns forward for 12 months, then repeated the process, right? I didn't do this in real time. This is you pulling all the data. And so last 20 years worth of data. So what you're seeing is, let's start with the average here. The dark blue, in good times where the stock market is moving higher, economy is moving higher, everything's good, we have the returns of high free cash flow stocks. That's blue. The average return is 11%. In good times, those stocks with low free cash flow, 8%, right? That's just the average. That's not all of them, right? If you take some of the outliers up here, this would be your semiconductors, really. So I don't know, there's a lot right now, but let's say there was a semiconductor stock that had high free cash flow. They outperform semiconductors with lower free cash flow, okay? And the point that we're making, it doesn't look so amazing here, I guess, unless you zoom in, but in good times, notice the spread is very small. It almost doesn't matter if you have low or high free cash flow stocks. You're going to get about the same return, within 2%, within 3%, within 3%, right? So we can live with that. The average is about a 3% spread. The trouble becomes, look at how wide the spread gets on the downside. It widens out. So as you work your way down, stocks that have high free cash flow, when there's a pullback, right? If we look at the 30th percentile, 10%, let's just go to the worst and look at it. Those with high free cash flow pull back about 23%. Those with low free cash flow pulled back 29% in that bottom percentile, meaning those with the lowest free cash flow, if not no free cash flow at all, and those that did have a positive free cash flow yield, but it was really small, right? So it was nothing compared to these guys, right? So the concept here is why on earth would there be a spread there, right? Sort of an in-depth geeky discussion here, but why there would be a spread is because you probably get it, in weaker times, those that have an emergency savings can do better. They can continue to grow. They can acquire struggling companies. They can do all kinds of purchases, maybe acquire talent, right, from companies that failed. They can acquire products or patents and things like that. They can choose to hold tight and just pay a dividend, right, to keep people to stick around. They have options. Very similar to you putting a few dollars in the bank every month, right? You have choices. When the economy goes to all you know what, you can actually go, hey, I always wanted a Porsche. That guy can't afford it. I'm going to buy his Porsche. You see what I'm saying? Like that happens. It's the same thing in the corporate world. So when we start looking through this, we got to recognize that we have less downside potential with higher free cash flow stocks. If the market is falling, but these stocks are holding up a little bit more, what did we just do? We held off some of the downside in exchange for really not giving up anything on the upside. So we're able to participate, and I'm not saying we would always have like low free cash flow stocks there, but we're able to participate on the upside. And anytime, if you decide like, I'm going to play a little protection here, it's usually cheaper to buy higher free cash flow stocks when times are good. Why? Because everybody wants risk. They want the companies that are spending every last dollar and taking on debt to grow as fast as possible. Yeah, there's a couple out there that you may know of right now. Okay. So that's why that works. And now we have the ability to participate less on the downside, more on the upside. Given enough time, as there's these waves in the market, given enough time, you end up looking like you're outperforming. You will be outperforming, but it's not because you could beat the market. You know, all the novice retail, really grumpy people out there, they go, you can't beat the market. Okay, well, if that's your goal, then number one, I would tell you, the market is a man-made object. It's not a magic thing. So if you want to go faster than a man-made object, your man-made object could potentially go faster. There is a lot that goes into it, but yeah, why can't you do it, right? So it's like saying like, you can't beat that guy that builds pools. Why not? We build pools. I'm sure it's very difficult, regulations, and I got to learn a bunch of stuff. I'll get through it. Yeah, the average person's not going to get it done. The other thing I would point out is you have to be kind of patient here, right? And this is not what most people can do. You have to have a wide portfolio that you can be patient on during those economic swings, because how many of you think right now the economy is about to fall off a cliff? How many of you thought that last month, last year, during the last election, right? There's always these moments, and it turns out there was no big deal. So you gotta be patient on this stuff. You can't be timing the market. I'm not telling you to time the market. So let's wrap this up with going through, I didn't make a slide out of this, but I quickly just kind of sorted everything sector-wise into free cash flow yield so you can get an idea. So biotech is historically one of the worst for no or low free cash flow. And probably makes sense, right? They have to spend a lot of money to develop their process, their drug, their machinery, whatever it is they're doing in the medical sciences world. It takes a lot of time and money to do that. And they generally have no sales until they're legally allowed to sell the pill, right? So you can kind of understand that one. Currently, the free cash flow yield for biotechs is essentially zero. And so very low. When they make a dollar, if they make a dollar, they can't save it. It has to go back out the door or they have to shut the lights off. So anything biotech, semiconductors and technology rank towards the bottom of the list there, anywhere from a 1.5% to 3% free cash flow yield. You've got the NASDAQ, an index, if you want to look at that, historically the second lowest index in terms of free cash flow yield. And that makes sense. Those are all the semiconductors and tech stocks and biotech, by the way. On the other side, the highest free cash flow yielding sectors or industries, I should say, are going to be regional banks, anything in the oil energy space there, oil and gas like the services companies, traditional mine drillers, things like that. What just came out today or yesterday, home construction. Big margins, right? And actually staying quite high if you happen to see that come out there. So home construction, that industry, about an 8% free cash flow yield, ranks in third place. Energy, I mentioned, home builders. So there was a disconnect there. There's two of them. Oil services, communication services is sort of towards the top, 5.9%. Retail and the large financials, right? So if you want to know what is that, what was the spread that likely made up the 90th percentile and the 10th percentile, gives you an idea of what industry those may have been in. I am not legally allowed to tell you to go and look at that or specific symbols and all of that stuff, but just keep in mind, this is what we do at Jazz. This is that behind the scenes stuff where people think that we're trying to beat the market, beat a sector, beat an index. And that's not necessarily true. We're trying to lose less. Every fund manager that's out there knows that a rising tide lifts all boats, right? That whole saying. You'll get there some way or another. You may not beat, but you'll get there. But what happens when the tide goes out? We all want to fall less than the market does or our benchmark does. That's the real focus you want to put on there. So I don't recall or have seen anyone talk about it that way, but maybe it's experience. Maybe it's just, they were busy or something, but I thought that'd be a fun one to talk to tonight. So I took a little bit longer. I know it's been a while, but I thought I would get a little something there. And I hope you learned. If you learned and it scared you, or you're like, oh, Dustin, do it for me, jazzwealth.com. There's the marketing, right? They tell me I got to do more marketing in this stuff. That's all I got.